Hey, welcome back, everybody, to the 4-Star Today's Market Explained podcast. I'm Brian Castle. I'm your host, and my co-host is Mr. Chris Reardon. Chris, are you there?
I'm there. Good afternoon, everyone. Glad to be on the show.
I think you are. Welcome, Chris. And just by way of reminder, everybody, Chris is our 4-Star Director of Development, master of all things portfolio, trading reports. He still loves his Cleveland Guardians now. It used to be the Indians, right? And actually, we have one Reardon on now, and we have a couple more on the way. So that's exciting stuff. So, Chris, welcome to the latest episode.
Thank you very much, Brian. And I will add, the Cleveland Guardians are now number one in the AL Central.
Well, there you go. Okay, well that's good. And I'm Brian Castle, founder and CEO of 4-Star Wealth. I'm an Eagle Scout, trustee of the National Boy Scout Foundation, philanthropic advisor to clients, advisor to CEOs and insiders, chief dad to Quinn and Evan, and husband to the amazing Tripty. Just a commercial. If you like what you're hearing, please tell your friends, share the podcast with them, and get them to sign up, and then give us a 5 out of 5 on Apple iTunes. So, Chris, we're going to do our standard program today. No interviews. We're just going to talk about the economy and the markets and what's out there. Chris, we've had some changes. It's been about 3 weeks because of vacation since we've done a taping. So where do we stand as far as the markets go?
Yeah, so we've had a little bit of change up. I guess not a huge amount, but we've definitely seen some mix-ups here. Number one is still commodities. It's got about 278 tally points, and it did move down 12 points from our last podcast. So we did see that continuation of commodities slowly rolling off kind of the highs. If you guys remember, it topped out around 320 tally points. So it certainly has come off that high. Number two, we have cash. It's at 193 tally points. It lost 4 points as well from the last podcast. So it's a positive sign. We're starting to see cash move downward slightly, which is overall good to see. Domestic equities in the third position. It's at 186, and it gained 10 points. I know we've had a little bit of a mini rally here, and we're seeing that showcase here as domestic equities has moved up 10 points. Fixed income as well gained 11 points in the fourth position. It's at 171 now. So domestic equities and fixed income have actually been moving in lockstep for the most part upwards. So in that 3 and 4 position, they are slowly starting to catch cash. So if this trend continues, we could see domestic equities move into that number 2 position potentially over the coming weeks. International equities did move down 7 points in fifth. It's at 148 tally points. So that continues to deteriorate. And currencies is still in last position at 114, and it gained 2 points, but still by far in last place there.
Thanks, Chris. So the trend here, commodities are ranked number 1, pulling back a little bit. U.S. stocks starting to work a little bit better, gaining ground. International stocks still losing ground. And then some of the, like cash is losing ground a little bit. So people are looking to maybe take more risk. So after the markets bottomed, at least in the recent trade, sometime in mid to late June, I don't remember the exact day, but then we've seen a couple of weeks of rally after that. The week of July 11th was down on fears of recession. Then we've seen the market rally ever since then. We're taping this today on the 11th of August. And the breadth of the market had been narrow, but it's starting to gain a little bit more volume. We did have a jobs number that was deceptively strong. So the concern has been the Federal Reserve is trying to raise interest rates to ward off inflation, which we'll talk about in a little bit. And with that strong number, which we think will be revised downward eventually, but everyone got excited about that number. So the markets rallied big this week. And so now we're seeing a lot of indicators turn positive. And the lower volume has turned around and it's become stronger. And we're up 15% from the low on the main indexes and 20% from the low on the NASDAQ. So we've had a big rally. And that's where we are right now, Chris. And anything else on the markets there?
No, yeah. I mean, I'll highlight this week. We had that the NASDAQ did touch that 20%, which technically puts it into a bull market. So we are seeing a pretty good run here, as you were saying, Brian. But I think all eyes really still lead back to looking at the Fed, and it's really been a week by week basis as the market and investors have really digested each number that comes out, the impact that'll have on inflation and what the Federal Reserve will do.
Yes. So we did have a rally similar in scope back in March. And then what happened was the news kept coming out that was more and more negative. And so then the market turned right around, went back down, broke the lows, went a lot lower. We might have seen the lows. We talked about this in our last podcast, but we might not have, right? We could see the market turn around and keep going lower if the economy gets worse. We'll talk about how the economy can get worse from here if it is going to. Now the federal government today is planning in the House to vote in the latest spending bill, which is mostly about green energy and priorities of the ruling leadership in the White House and in Congress. But they're saying that we're in a recession. We've already had 2 quarters of negative growth, and there's 400,000 level that will be the highest level that people will be taxed on. There's going to be new taxes issued, but I think technically they're saying no individuals would be taxed if your income is below 400,000 that level. But a lot of businesses are flow through to an individual tax return. So many of the small businesses are going to have higher taxes. So while they're technically correct that maybe individuals won't have higher taxes, a lot of people with incomes less than 400 are going to be taxed through businesses. So like everything, when you deal with politicians, you're not always getting the full story because there's just not enough money among the top 1% to raise that kind of tax money that they want. So anyway, so there's going to be new taxes. And Chris, the inflation continues, although it's faded a little bit. We'll have demand destruction from the inflation if we don't reduce inflation quickly. Consumer spending will decrease, and then that will eventually affect corporate earnings. So they really need to move fast to get inflation down. Just yesterday, the president came out and said this month there was zero inflation. Now, that's not really true because we were up, Chris, what was it, 8.6%?
8.5. Yep.
8.5% on the CPI year over year, but it was higher year over year last month at 9.1. That was the highest number that came out. So compared to last month, there was zero inflation or no growth in inflation. This month, that's what the president means. But that still means the numbers are really still high. There's big inflation, some record inflation, right, Chris?
Yeah, and I think one thing it's important to point out is, and I think the president said this, is some things went up, some things went down. I think it's important to note is a lot of the things that did increase, a lot of families and just general people will still feel. Actually, electricity prices still rose 1.6%. Baked into that number. Food prices rose 1.1%. And I think it's important to point out that's the 7th consecutive month of an increase of 0.9% or more for food prices. So those continue to move upwards, and rent prices increased 0.7%. So, food, lodging, electricity, all those still increased, and that still will hurt individual families, or they'll still feel that, I should say. But I think where everyone really felt it and where we saw the most movement was in gas prices. I mean, if anyone's filled up their car lately, it's obviously been refreshing. It's off the highs of over $5. I think it just averages now below $4. I think it just fell below that on average around the country. So we are seeing it in certain areas. Airline fares have certainly decreased, hotel rates, things like that. But the base necessities for families, even though the consumer price index came down from the high, some are still increasing certain areas.
Well, and then you said gas prices were down, so airline fares were down also because that's fuel related, right, Chris? Month over month.
Yeah. So gas prices were down 7.7%, and airline fares were down 7.8%. So huge drop-offs, I would say, from those two areas in particular. And I think that was the big driver behind that number, is we saw massive drop-offs from gas, airline fares, and these fares got ballooned up over the summer, especially. I mean, these were big drivers behind it, but It's still important to point out that some of the base things are still moving up, base necessities.
Now, what about the other income numbers, PPI, CPI?
Yep. Yeah. So we just talked about the consumer price index. The PPI was up 9.8% year over year in July. So still a very hot number there. It did pull back just like the consumer price index from the June number, which was 11.3%, but still a very high number. And a lot of economists, a lot of people look at the producer price index as kind of a crystal ball, if you will, into what the CPI is going to be. Because obviously if producers have to pay more, they usually tend to pass those costs along to whoever's buying them. So that's still a hot number, so we'll have to continue watching that. The personal income rose by 0.6% in June. So that's positive, but I think it's important to look at it. If you factor in taxes and inflation adjustments, that number actually comes out to negative 0.3% personal income. So after you factor in a lot of what's going on, we are seeing people losing purchasing power, really, is what that would show. U.S. household spending, though, was up 1.1% in June from a revised 0.3% increase in May. So that's positive, and I think that kind of talks about what you were mentioning, Brian. We still are seeing some spending there. Now, the fear is if we see that start to taper off and we see that start to go lower, that would start to drive even bigger recession and fears and a worse recession, I should say.
Yes.
Personal consumption expenditures price index, which is kind of what the Fed looks. It's just another way to look at household spending. That was up 6.8% in June year over year versus 6.3% increase in May. So that June number was good to see. We don't have the July numbers yet. We'll have to wait and see what that gives us. The Institute for Supply Management Index, that's kind of U.S. manufacturing activity. This is what it showcases. It was at 52.8 in July, a slight decrease from 53 in June. So we are seeing some contract or moving downwards in that index, but it's important to note anything above 50 is growing. It's not in contraction at all. So overall, it's still kind of a mixed picture, I would say.
Yeah. One of the confusing things, too, is that labor force participation rate. Of course, when we went through the pandemic, that 30% of the people left the labor force. Everyone left the labor force for a period of time. But then all that's mostly come back. But we're still now at the lowest labor force participation rate in normal times, 62.1%. Right, Chris?
Yep. Yeah, and that did decrease in July. It was by 0.1%. It was 62.2% in June. But, as you alluded to, Brian, earlier, I mean, that kind of deceiving employer jobs number of 528,000 that came out for July. There's a kind of a separation there, really. You have things that are pointing to a strong market. Then you have some underlying ways a lot of this is calculated that's kind of deceiving some of these numbers. The unemployment rate is still at 3.5%. But you still have about 623,000 fewer people in the workforce than before the pandemic, and there's a lot of people that just never even went back to work. So,
not quite 5 million people have never gone back to work who were employed in March of 2020.
Yeah, and what has this done? I mean, it puts the market in a very interesting situation because you have U.S. job openings are still really highly elevated. That's 600,000 now. So we still see high job opening levels. It is decreasing, but that's still there. And then this is also driving up average hourly earnings. So average hourly earnings are up 5.2% in July, and that's I think would be that 8th time this year that we've had wage gains exceed 5% each month. So we still have a pretty strong job market, although signs are pointing that it is starting to weaken slightly. So it'll be interesting to see how that goes.
Well, and mortgages got above 5% as rates were spiking upward. Now that they're back down below 5%, although in talking to real estate executives around the community, real estate transactions have slowed down dramatically. So a lot of the real estate companies broker homes are girding for impact, if you will, like how much this will affect them. Some say they're down 30 or 40% year over year in transactions from this point last year. How quickly we have fallen, because we were at record levels of activity and prices in April. And then, of course, all the way through July, the average home price keeps going up. So there is still an overall trend where housing needs to be developed in America, but in the short run, because of rates and other factors, that could be slowing things down in the short run. So in every bullish trend, whether it be home sales, there's always little counter mini trends backward before they resume an upward trend. And that's kind of probably what we're seeing right now, because there's still a lack of home development in certain areas. Plus, I think people's expectations for what they want to live in are different. A lot of folks want to buy newer homes, and a lot of the older homes don't get sold anymore. So sometimes older homes are torn down, and people want to live in newer dwellings. So there's that trend as well. So more and more people have always lived in a newer home as America has developed and grown so much in the last, say, 50 years. So if transactions continue to stay slow, well, then it might affect real estate prices, but it would probably be more in localized areas and maybe not a big national trend. But you never know how long these trends go, Chris. Like it could end up really affecting real estate prices if it goes on for a long time.
Yeah, I mean, I think one, like you said in the beginning, there still is a supply and demand mismatch, I think, which is in the favor of home prices in the short term, at least. So I think with what I've seen out there, they have we haven't seen these drastic overbids. Maybe those have kind of either slowed or gone away, depending upon the geographical location with where you're at. But we haven't really seen kind of a full collapse in housing pricing yet. We definitely are going to see a slowdown. I mean, unless you really have to move or sell, you're heavily incentivized not to sell, right? Even if mortgage rate is around 5%, if you bought your home 4 or 5 years ago, you're looking at a 2%, 2.5%, 3% mortgage. Most people are reluctant to sell and then buy a new house with a 2 or 3% higher mortgage rate. So we are seeing that slowdown in transactions, but for the most part, we've seen home prices hold up relatively well so far.
And we're going to get more of a read today, and there's a nice podcast interview we'll talk to you about a little bit later regarding mortgages too. So that's an important thing, because we all own homes and use mortgage financing for real estate. So now we've been talking, Chris, a lot about inflation. I just want to make some comments about that. Inflation right now is out of control. It's at record levels since the 1970s, and it was caused by a lot of government policy driving energy prices up. And then, of course, once it was already underway, not beforehand, then the war in Ukraine, with Russia and Ukraine fighting, took some of the grain market off the market. That's minimizing now to some extent. But then a lot of our policies limited supply of fossil fuels and oil. And we were the largest producer in the world. So we went from the top producer in the world to less than the top producer in the world through government policy and reducing supply, cutting off pipelines, cutting off drilling in federal lands, drilling in offshore federally controlled locations. So we did create some of this inflation. And so hyperinflation is a bad thing. Obviously, we've seen that in third world countries. We've seen it in countries in South America where hyperinflation destroyed their currency. But the reality is we do need some inflation. We need 1 to 2% inflation in a normal economy. The opposite of this, of course, would be deflation. And we've talked about the ills of deflation for a long time, Chris. When you can buy something cheaper in a month than you can buy it for today, you're going to stop buying, right?
Yep. Yeah. I mean, it really it really motivates people to just not purchase and to save, really, which obviously is something that's good. But when you're talking about the general economy, that's based off of people spending, going out, buying goods, all that stuff. Once that starts to grind to a halt, it spirals. It's really bad for the economy, and B, it's really hard to get out of a deflationary environment. because it's really hard to try to re-jumpstart that engine, if you will. So that in most cases, people look at deflation is the worst case scenario. We do not want to be anywhere near that. We want a healthy inflation.
Well, and because of demographic trends, the aging of America, and of course, Japan has seen this in probably the most pronounced way, and China as well, where their one-child policy is leading to a much more aging society. The demographic trends keep inflation from gurgling up. So we're always fighting to keep inflation high and not fall into deflation, because that was the biggest risk. So we do need kind of 1% to 2% inflation, and the Fed's target is to keep prices around 2% in that range, consumer price index. So while we're beating up on inflation, I just wanted to make sure we covered that. We definitely need some inflation. We just don't need it 8 or 9%. And by the way, if we calculated inflation like they calculated it change, like they calculated in the 70s, we'd be back in the high teens and close to 20%, and with the current metrics in our inflation. So it's as bad as it was in the 70s. It's just calculated differently. So anyway, and we talked about mortgages were above 5%. Now they're back below. So maybe the real estate prices will resume a little bit and transactions will resume a little bit. But we'll see. So that's where we are in the economy. We're going to talk a little bit about some new things we see out there, Chris. And then I've got some strategy discussions I want to talk with everybody about as well. So what do you see out there, Chris?
Well, I think we've talked about the Top Gun Maverick movie that came out this summer. That was a massive hit. Well, I just passed the Titanic at the all-time domestic box office rankings for the most grossing film. So it came in at number 7 now. It's grossed $662.5 million in the U.S. alone. So it's kind of I would say a cultural phenomenon. I mean, it ranks up there with likes of Titanic, which is obviously a very good movie and had huge significance there. But you also have a lot of the Marvel movies, Star Wars movies. You have some very, very big names, heavy hitters up there. And then you have Top Gun Maverick, which is it's kind of, I think, pretty funny. And then Samsung just came out. They released their new Galaxy Z Fold phones. And the price that they put on this was $1,800 for their new line of phones. So it's pretty ridiculous pricing. I mean, now we're getting essentially phones that are getting priced at the point where they're essentially computers. You can get computers for even cheaper than that. So we continue to see an increase in pricing on the cell phone markets.
Yeah, well, and Apple continues to do extremely well. And if anybody's been watching, the big decline on the first half was technology-related stocks. They're starting to recover now. But one of the best performing of those big tech names was Apple. Apple's almost all the way back up. So anyway, that's where we are. Hey, the other thing that I see out there, Chris, I was hearing from the comments from the CEO of Uber that they're getting a lot of new drivers, and 70% of their new drivers are adding work to pay for the higher prices. So it is starting to affect people out there. They don't want to dip into savings. They don't want to take more money out of their savings accounts and such, but they need more money to pay for the higher prices and the goods they normally buy. So that was interesting that people are taking jobs because of that. So anyway, then the other thing I just want to comment on, just as far as what we see out there, we talked about the strategy of protection of the downside, that if you can avoid big loss in a bad market, you'll be that much better off when things turn. And so we designed the 4-star protection program where 4 of our portfolios either go to 100% cash in some conditions or go to 50% cash. And the idea is to try to avoid major loss. So why do we protect the downside? Well, I have a really good story. Met a guy at a restaurant in New Buffalo, Michigan. And, it was a fun day. It was a Saturday, a beautiful hot day. We were all chatting. And I saw this gentleman had a Steelers shirt on. And I'm a Bears fan, Chicago Bears fan. So he had a Pittsburgh Steelers. So we started talking football. And then he said, well, what do you do? I said, I'm an investment advisor. He said, oh, boy, my portfolio is down. My portfolio is down 20%. I said, is Joe from Pittsburgh? I said, Joe, so what do you do? He said, I'm I'm scared. So I took a part-time job working at a grocery store because I don't want to dip into my portfolio. I said, well, what did your advisor say when you're down 20%? He said, well, I really don't work totally with that advisor. I have a broker kind of person. So he doesn't really have a good advisor. And a good advisor might tell him, Chris, if you're down 20%, that's not the end of the world. It's not great, but that's kind of the far end of where you can be and have it not affect your life. Like he probably is okay, but he's a little scared and he wants to go back to work and get a little bit of income to make sure that he's got a cushion. Okay. Mm-hmm. So if you can keep in a big market decline, the pullback to 10 to 20%, you're probably okay because you can make that money back in the near term. But if you're down 30, 40, and 50%, Chris, isn't it right? That's where you have big changes in your life.
Yeah, I mean, when you're down 40, 50%, that's where you really dug yourself into a hole. It's a lot harder to get out of that and recover. And that's, I think, that where you can really see that is we saw that for a lot of people in 08, 09, where, they were down that 30, 40, 50% in some cases. And a lot of them had to go back to work and stuff. So, if you can maintain, even hold it at around 10, 20%, you're in a much better position.
Yeah, absolutely. So if you're down 50%, if you do the math, everybody, you'll have to double your portfolio. So think about how long it would take for you to double a portfolio from a standing start, like right here. You put in, $100,000 into an investment account. How long would it take to get to 200? In normal conditions, about a decade. So if you're down 50%, you have to wait for another decade to make your portfolio back. So if there's a way you can avoid all that loss, boy, that would be the best thing to do. And that's why we designed the 4-star protection plan. This time, of course, we got a commodity rally. So it helped one of our portfolios, a dynamic, which was not only not down, it was up 4% on the first half. So we feel very fortunate that happened and lucky enough that our models did pick that up. But if investors can avoid major loss, that's really the key. Now, one of the big issues that we've talked about here about oil prices and about all the issues that are being caused in the American economy is policy failure, where our elected officials are making the wrong moves. Now, they may be making the right moves for their constituency or for their long-term views on things, but if it's affecting the economy, and at least from the economic perspective, it's a bad move. So it's affecting it so much that now even the party of the current president is saying they don't want him to run for re-election. Last I saw in the New York Times poll, 94% of people who say they're a Democrat don't want our president to be renominated, and they want other candidates. So that's just a reflection of the policies of the inflation and allowing crime to foster around the country. So a lot of things are going on that aren't. Some are economically related, some are not, but it's enough that it's affecting the politics. And so we have a system in America that renews the political system. If people don't like what's going on in the economy, they usually blame the president. Right now, they are blaming the president. And sure enough, it appears there might be a change of party in the fall because of that. So the politics and economics are always somewhat tied. And we're seeing clearly a melding of those two issues here together here in the last year and a half, certainly this year. So anyway, and I did want to mention one other thing. We are talking about changing from fossil fuel environment to an environment where we have electric vehicles, and everybody's in favor of that, of course. The question is how quickly. And I just heard an interesting discussion on the Presidential Daily Briefing. A shout out to Brian Dean Wright, who does this, and this is available on Apple iTunes and all the other services, about Hawaii passed a law where they had to get rid of all coal plants by September of 2022. Looks like they've achieved that, but they haven't built all the facilities, Chris, that would take care of solar, wind, and all the battery production for electric vehicles. So clearly, they're probably moving too quick. And they've already said energy prices are going to move up sharply in September, and maybe it's going to get a lot worse, but they really don't have it together. So without having a reliable source of energy, why would our public officials want to make that kind of change? That's when you restrict supply and prices go crazy. That's kind of what we're seeing. Who would do that? I mean, it doesn't make sense, but apparently Hawaii is now going to be a no fossil fuel state. Ironically, to achieve the electricity that they need in the short run, since they don't have enough generated from wind and solar, they're going to be relying on oil, but not coal. So they got rid of coal, but they're going to be relying on oil to make up 180 megawatts that they need every day. So it's a kind of a crazy environment here, isn't it?
Yeah, I mean, I think that anytime people try to synthesize a very, very complicated and complex problem to something as simple as, all right, well, let's just end this and end fossil fuels and be dependent by 2025 and, have everything's going to be hunky-dory. There's so much that goes into that. I don't know why you would, start, removing the coal plants before you even had the actual proper energy from whether it's solar or wind. But to build this solar wind plants, any of these things cost raw materials. And a lot of these, as we've talked about, a lot of these raw materials, you need to mine that material. Do we have the capability to mine the material to build this properly? I mean, there's so much that plays into that. And everyone tries to synthesize it. Well, we need to do this. We need to build electric cars. Well, that's a lot of copper. Are we comfortable then strip mining the earth to get copper to build all these? It's not as simple of a solution as they would make it seem. And I think that's something that's important to point out. And I think, like you said, Brian, it's important we move in that direction. But it's important we have a plan, a sustainable plan, and a plan that's going to work. I mean, it's what we're trying to solve here is hence global warming, and the key word is global there. We're doing all this economic hurt on ourselves, really, pain we're inflicting on ourselves. And, you have China who's pumping more CO2. You have a war going on. They're detonating bombs. I mean, pouring, obviously these are horrible things, but I think we have to take into consideration the U.S. making these monumental changes could have no impact on the global world order as is. So I think I think would do this country step back and actually put a reasonable, sustainable, and good long-term plan in place instead of these ridiculous plans to do things in 5 years.
Yeah, too short, too quickly. And of course, the voters are already in polls are already saying that they want change, and the people are moving too quickly. So anyway, well, we'll see how all that plays out and what the voters do, and we'll see how quickly we can move to renewable energy sources. Clearly, everyone's in favor of that. It's just a matter of how quickly and what kind of shock therapy we have to go through to get there. But that's about all we had for today. There are some blog posts out there that are interesting on the Leadership Matrix on fourstarwealth.com. We have an article about Goodbye to the Green Lawn, about the drought in California. And it's pretty severe. And so they call California the Golden State, but it's not because of the riches that are out there. Of course, there are some. But it's actually about the brown hills, because there's all the grass browns out, as a friend from California told me that the other day. Also, airline fares going under $300. That's a big thing, because we lost our travel culture in America during the pandemic. Then our airfares exploded now because of fuel prices are back down. Then also an article about cutting the cord or stopping the stream, about different channels to consume electronic movies and TV shows and everything. So there's big changes happening in the cable industry. And so that interesting piece on that. And then also there's some podcast interviews out there on Apple, iTunes, Stitcher, and Spotify in the 4-Star podcast. We have the Barones, Bob and Josh Barone. Bob is a Fed level economist, the former chairman of the Federal Home Loan Bank of San Francisco. He and his son, Josh Barone, run Universal Value Advisors, and they're also 4-Star advisors in our Reno location. They were with us on July 18th, and they have some interesting comments about the economy and about how things are slowing down and what it looks like. And then also the founder and owner of Instamortgage, Shashank Shekhar, We did that interview on August 4th. That came out. So if you want to learn a little bit more detail about the mortgage market, that's a very interesting interview. So have at it, everybody, and thank you for being with us. Chris, I think that's all we got, right?
Sounds good. I think that's about it.
Excellent. Well, on behalf of our great 4-star team here in Chicago, we got Laura, Chris, and Chris, of course, Jack, and Kamal. Also, Brian, Tucker, and Karen on the East Coast. We've got Tom. We've got Mitch, and all our recruiters. And so we're signing off until the next podcast, everybody. Thanks for being with us. Don't forget to give us a 5 out of 5 ranking. And we look forward to having you on for the next episode of the 4-Star Podcast, Today's Market Explained. Thanks for being with us. Bye-bye.